Good.
Everybody got speed?
Indeed.
Yep.
Speed. Okay.
Make this very much more right, please.
So, Scott, introduce yourself a little. Tell us who you are and where you came from.
So, Scott Nelson. I spent my career in supply chain in technology and finance. Started a business called Trax Technologies in 1993. Started as a contract software firm, turned it into a SaaS business, and then eventually a big data business.
Okay. Yep.
Sold it 2.5 years ago. It was in the supply chain space, doing settlements of transportation logistics invoices for some of the largest corporations in the world.
So, when you say settlements of the invoices, it was basically acting almost like a financial house, or?
We would do the audit and validation, cost allocation of the information that would come on the invoices for the transactions these companies would do, and some of these companies would do millions and millions of transactions a year.
Yeah. Yeah.
We would automate the the contracts to actually check to see that the invoice was actually done according to contractual terms, and validate them to make sure they were correct, as well as allocate the cost to the cost centers involved.
Okay. So, already we're going to zoom into all kinds of super interesting areas.
Yeah.
So, let's go back and talk about what supply chain is,
Yep.
and then go down the rabbit hole around automation of contract. So, I want to go and sort of talk a little bit about what a supply chain is and what the supply chain space looks like. Because I've learned over the last year or so a little bit about it from talking to blockchain startups that were doing supply chain stuff. And it's kind of like every time I learn a little bit more about it, the thing gets 10 times bigger, weirder, and more complicated.
It's really big.
It's really big, right? So we're both doing a bit of work with these guys, Ben Kabi, and they've been talking about the rice supply chain.
Yeah.
And you sort of think, well, how hard can it be to take rice from one place, take it to another place, put it in a pot and boil it? And it turns out to be like a 16-stage process, and these guys have tracks, and this all happens at the same time, and it's just
There's all
this
these intermediaries
endless fractal
yes.
complexity.
Yeah.
So, tell me a bit about the supply chain space. Like, what does it really look like? How does it really work? Like, what is a supply chain when people use it?
Well, first let's talk about the size of it. It's $54 trillion of GDP globally, which
a lot of money.
it's 2/3 of the world's global economy. It employs the largest portion of people on the planet.
Sorry, this might be funny, but that would explain why it's kind of large and complicated. So, well, it's 2/3 of the entire global economy. No wonder it's a little complicated to explain.
Well, it's just varied.
Yeah.
And it's called a supply chain because there's things that move from one party to another party to another party that are adding value, supposedly. Now, there are a lot of intermediaries that a lot of people would suggest don't add value, but that add value in a chain. In practice, it's more like a network.
Yeah.
In fact, if you looked at the topology of it, it would look very similar to the topology of the internet.
Yeah.
If you took all the supply chains of the world and mapped them out, it would look very similar to the topology of the internet.
Yeah, because you're going to buy your bolts from A or B or C depending on conditions, and you're going to manufacture products for D, E, or F, and it's all kind of interlinked.
And to buy bolts, you need lots of other things that basically come from the same supplier that builds iPhones, or that builds or makes the product that you buy in the supermarket,
So it's
little
all sort of
package
woven
and stuff.
together.
It's all very woven together, and it's all interdependent in many ways, and it's far more organic than people think it is. The supply chain is like the world's largest DAO. A supply chain for some companies economically is larger than many nations.
Yeah,
they're mid-sized countries.
Absolutely.
And so you're dealing with things that are just absolutely amazingly sophisticated, amazingly complicated, and supply chain management and supply chain activity really goes back centuries, in trade, and it really was the original distributed autonomous organizational structures.
Markets, right?
Yeah,
markets,
exactly.
Self-regulating, homeostatic, they maintain.
So all the markets in the world come from some in one way or another, have their roots. Banking has its roots. Insurance has its roots in commerce, and supply chain management is the science of managing commerce.
Interesting. How many people are involved in supply chain globally? Like,
I don't know the exact number. I tried to actually find it, but it's got to be close to at least 3 billion.
yeah. So if it's 2/3 of GDP,
Yeah.
so we're
So all agriculture,
yeah.
okay, all mining,
Anything
all,
you don't eat in the field goes into a supply chain of goods.
yeah. If Mother Nature,
Manufacturing.
yeah, absolutely. If Mother Nature didn't grow it there, or it wasn't created there, it came through a supply chain, was processed by a supply chain, or was stored in a supply chain.
So anything you use that you didn't take out your back garden came across one of these things.
Yeah,
and
everything
it's
you wear,
basically half
everything you
the global
consume.
economy.
Yeah.
Yeah. So, I mean, what we're really talking about is more or less the sort of organizing principles for roughly half of the entire world's activities.
A little more than half of the
more
world's
than
entire
half.
activity.
Okay. So that gives a sense of the scope.
And let me put it in a frame of reference, for example, particularly for those in the blockchain. Financial services, which has received so much attention related to the blockchain, is only 13 trillion.
Okay. So 4 times the size of all financial services.
Yes.
And financial services includes very dull things like mortgages, which are just same in, same out.
Exactly.
So by the time you take all that stuff out.
Yeah.
Okay. So supply chain kind of in that context, you may think it must be almost infinitely varied. There'll be a whole bunch of stuff which is, food logistics or things which are frozen or, bulk commodities like coal or oil.
High-tech
So lots of different
pharmaceuticals,
things
lots of
within these, all with their own kinds of ways of doing things, their own customization, their own structures and languages and ways of thinking.
Absolutely, but they share some very common fundamentals.
Like boxes in, boxes out, invoicing.
Invoice in, invoice out. And,
Yeah.
and the big thing that's different between inside of commerce and inside of a supply chain than in our commercial experience as consumers is that it's actually quite rare to get paid at the point that you actually receive something.
Right.
So there's this gap between the time an order goes to somebody to make something, for it to be made and then shipped, received and then paid for, and that means there's just absolutely tons of money. It's there's lots of different figures out there.
This would explain what it's like when you're a small, I used to be a small web designer.
Yeah.
And, back in the 90s. And, there's always that thing if you're waiting for the invoice.
Yeah.
When are these guys going to pay?
Yeah, when are they going to pay?
And the idea that half of the world is made up of people waiting for somebody saying, hey, when are they going to pay?
Yeah.
It's like, that actually sounds a bit like, that speaks to life as it is.
Well, and it's far worse than that because the larger corporations that have low-cost access to capital are the ones who basically are pushing on their suppliers to extend out their payment terms.
Yeah, I can read about this. Every time there's an economic downturn, they get slower and slower and slower to pay, and then all the small guys go bankrupt.
And so they're basically trying to make their receivables match their payables and their inventory. It's kind of a magic financial formula. If you could have the amount of money that you have tied up in people you owe be equal to the amount of money tied up in people that owe you, then you have a zero working capital requirement.
So I get paid, and then I pay all the people that I owe money to, and everything is fine. But if I have to pay them before I get paid, now I've got a hole which is the size of my total invoice.
Right, and or inventory too, because you might have actually paid for stuff that you're storing in warehouses or on your floor. So
timing becomes critical.
Well, it becomes critical, but as you go down the supply chain to get in the second, third, fourth, fifth tiers, more closer to the root of the supply chain, which is where things begin. These people are smaller and smaller firms that have less and less access to capital, and they're more likely to be in countries that have very high costs of capital or have no capital availability.
So you're growing coffee in Ethiopia, nobody's going to lend you any money.
No one's going to lend you any money, and you're staking Starbucks. It's really quite unfair.
And as you get to the edges of the network, the pressure gets more and more intense.
And it gets more and more intense. And so this adds cost through the whole system, and it places the burden of financing. And this is why the World Bank has identified this as the number one problem to solve related to getting global economic growth.
Oh, that's interesting.
So small and medium-sized businesses access to capital.
So access to credit for small and medium-sized businesses, the World Bank says, is the number one problem.
Yeah, for economic growth in these countries that have are developing environments that have these high costs of capital, have lots of poverty, it's the number one problem.
That's amazing. And these are existing running businesses that are just undercapitalized, so they can't invest in tools, they can't do...
Well, and it makes it very difficult to open up a new business. So what it does is it creates these environments where the rich, who have capital, have a disproportionate advantage. And the companies that they own, the big companies that are owned, the simple way of understanding this is that if your cost of money is 20%, and that's not outrageous in some parts of the world, okay, that's a 20% interest rate, and somebody else has a ton of money, and they're competing with you, and their cost of capital is, say, 1%.
So they can borrow for vastly less than you can borrow for.
Well, it's worse. Okay. They can borrow for vastly less, which means they can compete with me in ways I can't. But it's worse than that. They can be 19% less efficient.
And still beat me to price in the market.
Well, and still, and I am just at equality, and I don't have access to the capital.
Wow.
I can't even get investment.
Wow.
I have to invest my own money. I can't borrow somebody else's money to invest it. So I have this growth inhibitor, plus and so this happens all through supply chains.
Got it.
The really efficient people can't compete with these giant organizations that are inefficient.
Because of lower cost of borrowing.
Because of the lower cost of borrowing, which subsidizes their inefficiency.
Wow.
So they can be basically worse at what they're doing.
So this is the enormous kind of like...
It's a double tax.
Boat-like quality that you get of large institutions where, they just never seem to die. It doesn't matter how bad store is, it just never goes away, because anything that wants to compete with it has to push against that borrowing cost.
Well, it's that they have this unfair advantage in that their borrowing cost means that they can be less efficient, less effective, deliver things that are more expensive. Then that's edge one. The other edge is that you have that they're able to get cash. They can get credit, which means they can make investments. So they can outcompete you in terms of new products, new services, new facilities, new whatever. And they can maintain more inventory, more choice, other kinds of things. So they can be both less efficient and more competitive. And that's something that people just don't get. And this is true everywhere through the supply chain. This is not an isolated problem.
It sounds like it basically anchors mediocrity and scale.
It does.
So it's like a general theory of why we tend to be surrounded by kind of crap large organizations.
Correct. And so this is and it's not that all organizations large organizations are inefficient. There are some very efficient large organizations.
But the large organizations which are inefficient are hard to kill in the market.
They're hard to basically displace because they have this unfair advantage of cost of capital. The other thing that's going on is that in supply chains, and this is a statistic that comes out of all the strange places as the Federal Reserve of the United States, is that the global utilization of assets in supply chain, factories, warehouses, trucks, boats.
So the degree to which these things are used fully.
Yes.
Okay.
Yeah, that means if a truck's driving down the street, is the thing full or is it only got one box in it? It costs the same much to drive down the street if it has a full truck as a single box. Pretty much. I mean, there's a little bit more gas, but it's not significant. So how much are these assets utilized? Well, 50 years ago, the average supply chain asset was utilized 90%.
Which sounds pretty efficient. I mean, 90%
it was pretty efficient. It's now down below 75%.
So it's become 2.5 times less efficient.
Correct. Wow. And that trend is continuing. There's nothing that's stopping that. And that's happening through hyper competition and through as our environments become more complex. That we have broken things up into these different silos, and as things have been broken up into these silos basically become locking information about what's going on with their assets because they don't want to share that information because they're afraid competitors or customers will take advantage of it.
Like Uber is not going to tell Lyft where its cars are.
Correct.
Yeah.
Same concept, or who their drivers are.
Yes.
And so what's happening is that the more complicated things get, the more we basically break things up, and the more competition we inject in the environment. When you're dealing with assets, you basically continually suboptimize them. And so not only have we made things less optimal because of these massive differences in cost of capital, but we're also making them suboptimal because we have all this underutilized capacity, which could be used.
Oh, wait, hang on. So it's 25% of all of the infrastructure that's supporting the supply chain
is underutilized.
Which is roughly half of all the stuff in the world, which turns out to be kind of like an eighth of the entire capital base of humanity.
Yes.
I begin to understand what you're playing for here.
It's really, really big.
It's quite large.
It's quite a large problem. And then the final thing is that we're in a world where the pace of change is accelerating, and we all kind of feel this.
Disorienting.
Yeah, I was watching on the BBC last night, and the iPhone was introduced 10 years ago.
Yes.
We take it for granted,
10
the smartphone, right? And it was only 10 years old. So the pace of change is accelerating, and the other thing that's happening is the explosion of choice is increasing. And so the opportunities to do new things, to make changes in the networks so that our supply chains are increasing at an ever greater rate.
Okay.
But
so the diversity of what's on offer is going up and up and up.
Is going up and up and up.
Okay.
But what's happening is that companies are reaching a point where they can't afford to optimize themselves fully, because the change management that they have to go through and the project management cost, the investment they have to make in personnel, consultants, systems changes and other things to change their systems to make themselves more efficient, are happening now so fast.
So the external world is changing so rapidly that for me to keep pace with it.
You can't.
Okay, so
you can't afford it, and you don't have the change management ability to manage all the change.
So you kind of start a 2-year project to overhaul something, and then 8 months into that project, you need to start another one.
The whole premise,
4 months into that, another one.
You might have cost justified this change on the idea that this will, save me money over a 3 or 4 year period of time. And, 3 or 4 years from now, your entire business model was changed because some competitor came in.
So
and
you can't kind of do the internal investment to build systems that actually work better because they just don't. The situation is so unstable, you can't make it pay for itself.
Yes, and this is and so what's happening is companies are becoming less and less willing to invest in long time.
Oh, so we can't do deep optimization.
We can't do deep optimization.
So you wind up basically just doing quarter by quarter micromanagement. You don't get the big investment in long-term change.
And then that creates instabilities in the market, so that people can't respond effectively to major changes, like Alibaba or Amazon. These are these.
So I mean, it sounds like this is almost like a resilience argument that 50 years ago, change is slower. You kind of figure out how you want things to be. You do the heavy engineering. It takes you 10 years. You get it run around, and then you live off it for the next 20. And as that shortens, making the change stays expensive, but you still don't get long enough. You don't get a long enough stable period afterwards to get the real benefit. And then things stop changing, so they get more and more out of sync with reality, and then eventually, presumably, they break.
And so this has a massive human cost because. Used to be, 50 years ago,
I mean, this is like the electric car, right? The existing companies are unable to deploy electric cars. They can't develop them, they can't build the tooling, they can't bring them to market. And then, Tesla comes along and suddenly you realize that all the big old car companies are in sudden death danger.
Yes.
That kind of phenomena, but everywhere.
It is that kind of phenomena.
Okay.
And the pace of that and the likelihood of that happening are occurring greater and greater. What happens to humans, us, as this happens, is that that companies that we work for have a greater and greater need of just generalists who can basically adapt to things, and the specialists who are in many cases extremely experienced, highly educated, and whatnot, start to become marginalized more and more. And the maximum amount of time that you can basically expect to be in any career is shrinking.
Oh, because specialization takes time to master.
Specialization takes time to master.
So this is the whole 10,000 hours.
Yeah.
So there's less and less
economic benefit for companies investing in 10,000 hours.
So you don't get the same depth of expertise.
That's exactly correct. And so this also sub-optimizes the system.
So this is basically an argument that things are moving so quickly that everything is mediocre.
Yes.
That does seem to fit the kind of lived experience right now.
Yes.
That everything seems to be a little bit grey and a bit difficult to get working properly because nothing seems to be able to keep track.
And this is happening because of the way we've decided to run the economic system.
Okay.
So we sell people that they can work for a business and get a salary. And in exchange, they transfer all of their intellectual property, all their skill to the business who utilizes it, and they make money from that.
Yeah.
Okay. So the problem is that the people that have deep skill, even when they're inside of big companies that have developed it, are increasingly spending less and less and less of their time using that deep skill for what they're supposed to do, because they're in these roles that are these more general roles where they have to show up at meetings and do all these other things that aren't really in the...
So your surgeons spend half of their time managing department rosters and this kind of stuff.
that kind of thing. And in business, it's far worse. And so and a company's ability to commit to people that have expertise for any kind of period of time is becoming shorter.
Right, because the shadow of the future is increasingly uncertain.
It's becoming uncertain, right?
Right. Okay.
So, and then even when they are, and so it is not that there's a bunch of bad companies out there that don't care about their people anymore. It's that to survive, the environment the company is working in is changing so fast that it can't actually predict the future well enough to actually anticipate
so
what it's going to need.
Invest. So what we're seeing is this pervasive short-termism based on uncertainty about the future. So and this is kind of like a kind of bow shock of the singularity, that the rate of change goes up and up and up, and existing structures begin to break down.
And this is why you get things like, the proposal for like a, minimum livable wage and that kind of stuff, which is a governmental solution to this problem. You just put
bulk buffering into the system,
right?
So when things go wrong, they don't go all the way wrong.
But that just basically keeps supporting this. It's not that I'm against that. It's just that it doesn't really fix anything, because it doesn't really attack the problem, which is that we have talent locked up inside of companies that is mismanaging the talent because it can't do anything else.
Right, so inefficient systems that are locked into place by rate of change.
Yes.
So all we need to do is reduce the rate of change by, say,
75%.
We could just slow everything down and we could get back to doing this stuff right? So that's what you're going to propose?
No, that's not what I'm proposing.
Okay, well that was
because I don't think you can go back.
Okay. So we're on a ratchet.
It's kind of like anytime you invent something, you can't uninvent it.
Yeah.
And somebody will, if you don't adapt and you don't basically learn to respond to it, somebody's going to take that thing and use it as an advantage.
Oh, somebody else will, sure.
Somebody else will.
But this is a hamster wheel, right? I mean, the faster we go around the wheel, the faster the wheel spins.
But maybe not. Maybe the problem is the model is basically broken because it's based on a set of assumptions that come from an error that doesn't exist anymore.
Right. It worked well 100 years ago, it doesn't work now.
Correct. And the fundamental thing that's happening is we're in post-industrial era, and we're entering it. I mean, but people don't really recognize
20-30% of the economy is post-industrial.
Yes.
And most of the culture.
Yes. But more importantly, supply chains and commerce have to become liquid. They have to become able to adapt faster and to be more autonomous and to get liquidity in the sense of capital, liquidity in the sense of assets, and liquidity in the sense of talent.
So let me summarize where we are so far, because we're covering an enormous amount of ground. So we start at the beginning. Roughly half of the entire world's stuff is wrapped up in supply chains, both people and assets. The supply chains are
probably more than that in assets, but
and the supply chains are part of a system which is going faster and faster and faster and faster because of technological change, maybe political change, ICT, whatever it is.
And it's about to just kick out of it. People don't even get what 3D printing is going to do to supply chains.
Absolutely.
People are talking about AIs, but the bigger impact is going to be in 3D printing. And
all of that stuff about mass customization that was talked about 20 years ago that never happened and is about to happen. All of that. I used to live in Iceland, and I helped them get a fab lab started, because the argument we made to the government was that 3D printing for manufacturing in Iceland will be economic 5 years before it will be anywhere else, because they have to import everything, and they've got such a small population that if you've got kind of like size 14 feet, you could wait a year for a pair of shoes. So if you begin to build that stuff in the areas where you've got a structural subsidy because they're just so far away from the rest of the world, the idea was that they could then export their expertise once it became economic in other places. And for them, that was a realistic possibility 5 years ago. And 5 years from now, they might start to see dividends from it.
Well, what really blew my mind about 3D printing was when I was visiting a company that makes garden equipment, right on lawnmowers and other things.
Yeah.
And they took me to their lab,
Yeah.
and I was expecting to see robots.
Yeah.
There were no robots, there were 3D printing machines, and they were 3D printing the engine components in their lab.
The engine components.
Engine components.
Steel.
That's when the light went on.
Steel.
No, they're actually using a combination of ceramic and different alloys.
Okay. Wow. That's amazing.
Yeah.
Because if you
when
can 3D print an engine, I mean, you could do anything at that point.
well, that's what when that light bulb went on, believe me, it was like, okay.
So, half of the world, or a bit more than half, rapid rate of change driven partly by technology, partly by society.
Yeah.
As a result, the efficiency with which we're using the assets in that system drops and drops and drops. So it's like the friction, the waste is increasing as the rate of change makes it harder and harder and harder to make good long-term decisions.
Correct.
So it's almost like you're driving faster and faster and faster at night, and the headlights provide you less and less and less warning about what's happening.
Yep.
And so you wind up
It gets more and more dangerous.
Yeah. Okay.
So the solution to this is not to slow down, because that's going to be impossible. You're not going to be able to do that. It's not that you can't slow down some things, and that isn't a good idea. It's just that you can't slow down commerce because it's competitive environment. Right.
So the evolutionary pressure constantly follows as people to
Constantly
optimize.
follows it.
And as we've seen, right, you can get environments where an ecosystem winds up dominated with kind of dumb, annoying animals rather than pretty ones.
Yes.
Just because the pressure is so tight.
Now, so let's
Like
say
sheep.
So let's say instead of saying, "Oh my God, this is horrible," this is terrible. What do we do? Why don't we, if we step back and say, "Well, why is this happening, and why is it hard?"
Yeah. But it's not just rate of change that makes it hard?
No, it's not rate of change. It's the centralization of production.
Okay.
So the industrial era started with centralizing production.
Right. So
It then-
Fordism, right? Taking a production process,
Creating assembly line, doing it in
Specialization
mass,
of each
specialization
role.
of each role.
Yeah.
Having one plant that built everything, that kind of thing.
Yeah.
It then moved to centralization of capital.
Okay.
Okay, this was
Banks, trusts.
banks and other things, but also big corporations that realized, I'm not only centralizing production, I can be this giant gravity well for money.
Yes.
And
so this is the era in which all corporations basically become banks that lend money internally to the various business units who want to do stuff.
yes, and I mean, it's not just that they become banks; it's that they recognize that they had the power to sell stock, that they could raise bonds and other kinds of things at very low cost. This wasn't something you did pre-World War II. Okay?
Yeah. So this is large corporation as financial institution, not just as shop.
Not just a shop, and as a financial entity that was financially managed,
Yep.
not just for central production, but for centralized finance. So
Yep.
I could have these divisions and do these other things out here, and I could compete in the world, not because I centralized production and made things more effective, but because I centralized my ability to get cheap capital and then give it out to places in the world where cost of capital was really high, like some developing nation.
So this is like a bridge.
Yes.
So I take capital in where it's cheap in the first world,
Yep.
then I move the capital into poor countries, and there it has this enormous leverage because they have such a high cost of borrowing.
Yeah, and even in the first world, I have this capital that smaller businesses can't access, which open up opportunities for me to compete that they don't have.
Fascinating.
And then the
So
third,
this is one of the fundamental big things get bigger drivers.
yes.
This is one of the things that keeps the winners on the
And this
table.
is the whole theory about economy of scale. It's one of the things that people realize is, well, it's not just the scale of the production that we can do scaling of capital.
Right.
The third thing was then the era of centralization of risk. And we're just moving out of the impact that had on the global economy. The 2008 crash was in many ways a result of trying to centralize risk.
So we start with centralization of production, which is economies of scale.
Yep.
Then you get this low-cost access to capital, but in the process, you've taken in the capital and you're now spending it on things which have inherent risk. And this is the centralization of risk.
It's not just that you're spending it on things of risk. People realized, well, you could not only centralize the management of capital and do it cheaper.
Yep.
You could centralize the management of risk and hedge your risks so that, literally, this was the argument, that I could basically have no risk.
Yes.
Because I've so effectively,
Yep.
and I have almost no cost of capital,
Yep.
which means I can use all the money I basically can
So I
dream
can
of
borrow
using
the
for,
money basically for free,
Yep.
and then I can make sure I never lose any of it.
and I never lose any of it.
Because
Okay?
it's all spread across this hedge.
Exactly.
So this is hedge fund thinking.
It is, and it's where derivatives come out of and all that kind of stuff. This is all a part of this idea of industrialization.
Yeah.
Okay, but it's the end of the chain. There's nowhere to go after this.
Because once you've managed the risk stuff, there's just nothing obvious to do after that.
Well, it's because all of the systems there are based on stable environments. So long-running stable. So think about centralization of production. I'm going to build this giant factory, invest a whole bunch of money,
Economies of
create
scale.
a product, and I'm going to crank that product out for years.
You
right?
print 1 million of them, and that's why it pays for itself.
Yeah, right, exactly.
Yep.
That's gone.
Right.
That doesn't exist anymore,
Right,
except in
right.
some very small edge cases.
Yeah.
The
when we use-
centralization of capital is the same thing. I can
Yep.
bring all this capital in. I can then invest it and use it in ways that basically give me an advantage.
Yep.
In the fast-paced, changing environment.
Harder to identify.
Harder to
the
identify
advantage.
and less likely because I'm using heuristics.
Right.
I'm using all the things.
And you
that,
get less carrying capacity because when the window does open up, it's not going to be there for 20 years. It might
then
only
I-
be profitable for 3.
Then I layer on top of that the attempt and the belief that I can basically centralize the management of risk, and I get massive instability.
Right.
Okay, massive instability that will become
So-
more and more and more unstable.
So everything starts nicely hedged, and
Yes.
then the environment changes, but we still think we're
the
nicely
assumptions
hedged.
on which all that was based,
And
you get 2008.
And the contamination is that everybody's buying everybody else's risk.
Yep.
Because the assumption is that the risk in the system as a whole cancels out.
That's it.
And in fact, it doesn't.
And it doesn't. And that's been, we've tried to make that somewhat marginally better because it's kind of like what happened in the centralization of risk is kind of similar to what happened in manufacturing where we polluted the rivers.
Yep.
And we realized, that's like a bad idea. So, we need to do some cleanup and we had to pass some legislation and we had to put some effort in making that something people didn't do.
Yep.
We've tried to do the same thing to the centralization of risk.
Yep.
But the fundamental problem is that we are centralizing things that now don't actually have economies of scale. So in rapid changing environments, small things are more flexible.
They're adaptive.
They're adaptive
And they can die and then...
and
you
have
can learn.
much lower impact
Yeah.
and whatnot.
Yeah.
So
So at the worst, you get an evolutionary pruning. At the best, you get rapid learning.
correct. And so in small teams, small environments, what you want is the reduction of friction and the ability for them to do things.
Yep.
Now what they need is the same things that the centralization provided. So what centralization provided was the ability to do massive coordinative activity for creating things. Okay. Well, supply chain, particularly in the last 20 years, has evolved so companies, the really large companies like Hewlett Packard or Apple Computer or many product companies, they're just engineering firms or product design firms. They basically send
the whole thing
everything's outsourced.
It all goes to Shenzhen, and they
It
come
all
back
goes
with
to
whatever you
other
wanted.
places, right?
Yeah.
And they use supply chains to manage that. So supply chains
what I'm-
are the way in which you can take very complicated, very sophisticated product and break them up and distribute them over of an ecosystem of suppliers. You might have 10,000 people building stuff instead of one giant plant. And
Okay.
this is
So hang on.
already happening.
So let
okay?
me break that down. So I remember hearing that the Ford motor plant back in the day took in coal, steel, and rubber.
Yes.
And out the other end came cars.
Yes.
That they did everything from raw materials on a single site.
Yes.
So supply chain in the form that you're talking about it is basically an industrial ecology.
Yes.
Hundreds of thousands of possible products, all millions, tens of millions of possible products, all woven together. So when you want to assemble something, you pull on suppliers who pull on suppliers who pull on suppliers.
Yes.
So it's kind of systolic. You just kind of pull out what you want and everything's connected to everything else.
That's right.
So onto that matrix, you then, or onto that onto that frame, you then load ideas that then pull things out of the supply chain into these kind of patterns.
Yeah.
But the underlying supply chain architecture is hundreds of millions of different decision makers who do different things as part of their own autonomous economic units.
Yes.
Okay.
So this is really the promise of the blockchain, right?
Well, this reminds me of the big three economists of decentralization, right? Coase, Nash, and Benkler.
Yeah.
So Coase talks about what happens as you get increasingly cheap information is that the unit of information decision making becomes smaller and smaller and smaller. Because the reason that large companies are large is because it amortizes the cost of decision making across the entire company.
Right.
And that as the cost of decision making comes down, the companies shrink.
Yes.
So we haven't seen that happen in developed countries for information services, right? Amazon, eBay, etc., are all enormous for reasons I don't understand. But it has happened that way for supply chain. The physical world
is
is broken
happening
up
that
into
way
small
for
pieces.
supply chain.
Okay.
Although what's happening is that you have, and it has happened in the big companies too. But what has happened is they basically have done it. They've masked that it's happening through acquisition.
Yeah.
So they. So they basically buy up all the other companies, and they're able to do this because they're low cost of capital.
Right. Right. Right.
So we all get back to the fact that liquidity is actually at the root of this is the root core problem, and this is actually
winners stay on the table because of their access to capital, and this is the liquidity trap.
that's that, and the fact that the entire structure of this economic system of innovation is built around a stock model of ownership of companies that is no longer really a very effective, and I'm not saying it doesn't work. It's just that it's getting to its end of its useful life in certain cases, and
because what you're buying with stock is risk, right?
well,
But
you are buying risk, but
it's a whole packet of different risks all wrapped around each other. You can't just buy a slice of the iPhone. You have to buy Apple.
the big problem is that management or owners of businesses don't have a way of becoming liquid without going through either a sale or a initial public offering.
Yep.
And we've made it so dang hard for people to do an initial public offering,
Right.
and so frankly risky for the people involved, and so expensive
Yes.
that that's becoming less and less and less the choice that people want to make.
Yes, they're going to private equity more and more and more.
More to private equity, and so but they have to actually sell.
Yes. Oh, so you take the brains off the productive capacity,
Yes.
and you have no idea whether it still works.
Well, and it frequently doesn't. I mean, the history of private equity
So
is
it's becoming
somewhat,
harder and harder and harder to keep the innovation on top of the capital.
well, and we have this artificial approach to the problem. So we've said that you need to work to build up this business, and then you can have an exit, or somebody creates a business and grows it for 20, 30 years, and then they can't. In the years gone by, if you had a farm or something, you passed it on to your kids, or you had that kind of situation. That doesn't work anymore.
Yep.
And so we have all these models for how value gets created and value gets transferred that still favor this aggregation of capital that's at cheap cost.
Yes.
And the capital is looking for ways to make money because the fact that it's cheap
Yes.
and accessible, what's happened is that there aren't, if you got money in a savings account, you can't make anything off of it. So,
Right,
so you have to find better ways of investing it.
Yep.
And so your choices are, you can enter the stock market or bond market, or you can basically, if you've got large sums of money, you can put your money in funds like PE funds, VC funds, and you're going to do that for some portion that you're expecting to make a high return.
Yep.
All of this happens because money is scarce, and there's a fundamental model of money that does not need to be true anymore.
Okay.
And that fundamental model of money.
Hang on, before we go down that rabbit hole. So let's just make sure we've got the argument reprised today. So we have this winner stays winning property, right? But the problem is that we're making it harder and harder and harder for entrepreneurs to realize some of the returns while continuing to use their skills in the business that they created.
Yes.
Because the IPO thing is harder and harder and harder, and private equity sales tend to deprive them of control.
Yes.
Okay, so that sounds like another innovation bottleneck, where you can't get the good stuff done because you're basically the system basically drives a wedge between capital and talent.
And talent. And this is, there's no place this has been more abused than in, some egregious examples of places like Silicon Valley, which kind of created this stuff.
Absolutely.
And the problem is that in an attempt to de-risk risk investment, because as a VC fund or a PE firm, you have to get money from other people, and you have to convince them that you're a better place to put that money than something else.
And that means you have to promise them that you will never lose their money. You will only invest
and you'll have these great returns.
Incredibly
this 20%
high-risk
year-on-year.
businesses that never fail.
Yes, exactly. And so, what in order to manage that, what they do is they've created all sorts of legal art that are things like blocking rights and preferences and other things
Yes.
that give them an ability to renegotiate the terms of the
Yes.
deal whenever something is not an utter bust or a supernova success.
Yeah, yeah.
Okay, to
So
kind
in
of
that kind of 90% middle ground where it didn't explode.
it's far more than 90%, but
Yeah.
and they'd like to say it's 90%, but it, so in that middle ground area, they have a disproportionate advantage with
Yeah.
the people that are actually working there,
Yep.
and in an environment that's becoming increasingly risky.
Yes.
I mean, think of the
Rate of change, right?
The rate of
If
change.
only rate of change.
Right, and so you get this idea that disruption and all this is going to basically change everything and make everything new. But the pace of this is making even the disruptive things have effect for less time.
Yeah, absolutely. I mean, the half-life of companies in the Fortune 1000 used to be, what, 15, 25
Yeah.
years or something, and
Yeah.
now it's down to less than 7.
Yeah,
So if that's what's happening even at the Fortune 1000 scale, the startups are getting crushed and crushed and crushed on shorter and shorter
yeah.
cycle
Well,
times.
look at the backlash for companies like Uber, who I mean just didn't exist a few years ago, right?
yeah.
And became this wonderfully big success overnight,
Yeah.
and then all of a sudden now there's this giant social backlash against them.
And they're still hemorrhaging red ink.
Exactly.
3 billion a year or something
That's
losses?
crazy.
Yeah.
So you.
Good cheap cab fares, though. 3 billion a year of subsidies, it ought to be cheap.
So the whole system is trying to basically the problem is how we treat money. So those who have it want to protect it from deflation and want to make more from it.
Yeah.
Because they don't want to use their principal, they want to make money they want to live off of the interest.
Yes.
And we have a system where money has got a limited supply. So there's the 60
we're
to
talking-
70 trillion.
So when we say money, we're talking about fiat currencies
Fiat
issued
currency,
by nation
that's
states.
right.
Yeah.
And you have maybe as many as $700 trillion worth of valued assets in the world.
Okay. So there's way more valued assets than there is cash to buy the assets with.
That's right.
Yeah.
Okay. So and there's other things you could buy with stocks and bonds and other things. But if you add even all that stuff up, it's still only maybe about 120 trillion or so. And so you have these two problems. Actually, it'd be more than that. More like 150, 160 trillion. But it's still way
a
less.
third of the asset
Still
pool,
way
quarter
less
of the
than all
asset
the valued assets.
Yeah.
So the problem is there's not enough money to go to buy everything.
Yes.
Okay? And money is in a limited supply. So people who have money want to keep it, and the people who don't have money are trying to get it.
Yes.
And to get it, they have to rent it from someone who has it, who could use the money in some other way.
So you're going to the bank and you're saying, could I please have some of your money to go and do
Or
this
to
thing?
a PE firm or a corporation or whatever.
And they say, well, there are 37 other people that might want this money, so I'm going to give this money to the highest bidder. So we were talking about fiat currency,
Yep.
on the order of 70 trillion available, but 700 trillion of priced assets.
Yep.
So why is there less money than there is stuff to spend the money on?
Well, there always has been.
Okay.
Monetary systems are basically started in the world as kind of two different systems that grew up, kind of in parallel. One was some kind of local market system, which was used to actually conduct trade locally.
Okay, so this is the kind of farmer's market in prehistory where people would turn up with their goats and their sheep and their chickens and their kale and all that.
Yeah, I mean, it goes back to 5,500 years ago. The Egyptians had clay tablets that they would take goods into, like a pharaoh-run official governmental-run warehouse, and they would get a cuneiform
seals on the
tablet, and the
doors
pharaoh would seal it and
Yeah.
whatnot. You can go see these things in the Cairo Museum.
Yep.
And they were kind of a moniker for some set of goods. And instead of, the barter, that everything was bartered was a myth. I mean, that didn't really
This is
happen.
what Graeber's talking about
Yes.
in debt, that
Yes.
basically it was all done with debt. The barter thing was just, like accidental commerce.
Yeah, well, it happened during wars or around the edges of economies during distressed situations. Then the way you went between systems is you used something economists called specie.
Yeah.
And specie was gold, silver, precious metals,
Yeah, the hard
stones.
currencies.
Yeah.
Do you know Bernard Lietaer?
No.
So he was he was an economist who designed the convergence mechanism for the European Central Bank that turned into the euro. And then he kind of went off the rails in the 1990s and left mainstream economics and started writing specifically about systems which had dual currencies from history.
Yes.
Pointing out that you basically had a hard currency and a soft currency.
Yes.
And the soft currencies were what provided the liquidity, and the
That's
hard
right.
currencies were what provided the fungibility.
That's exactly correct. And so it was really in the late 1800s that we collapsed these two currencies into one.
So we just wound up with hard currency.
Well, we just wound up with one, which is a national currency,
Yeah.
and most industrial nations outlawed, in one way or another, the ability to use any other currency. And,
Yeah,
and some of this happened hundreds of years earlier.
This is the whole
Chinese
thing
and stuff.
of legal tender, right?
Yes, legal tender.
Everything else gets made illegal.
Yeah, exactly. And that's how the United States, for example, ended up with the gold standard and the gold certificate and whatnot.
Well,
What happened?
Let's drill a little more down into that. So prior to, you have this kind of prehistory with the clay tablets and people writing down what they've got. And then it kind of rolls forward. Is there a period where everything is being done in gold and silver?
No.
No. So it
Never.
goes from that initial trading system to just printed banknotes with nothing in between, or?
No, well, the
So-
different. So you had like marketplaces that emerged in the Middle Ages that had, where you would have one kind of, or maybe two or three anchor merchants, who would have script that they would issue, that everybody trusted to issue, kind of a common.
So like
script.
a kind of promissory note, like.
Yeah, but it was typically related to some kind of commodity, like shoes or bread.
So
or,
I'm the guy that turns up with cotton every week,
Yeah.
and I say this is worth 3 rolls of cotton. Come back next week, and then people are casting that around like banknotes.
Yes.
Okay.
Yeah, and then you had the asset-based lending that banks started. Okay, so this is what a banknote means. A banknote goes from people would bring in an asset to the bank, like title to their property, or next year's promise for next year's crop. Later on, shares of capital, and would withdraw banknotes, and then the banknotes would be traded within a local ecosystem in order to provide, buy goods or services within that local ecosystem.
I see.
And then, this had some. This was good because it created local area networks where the liquidity was great. It wasn't so good because governments, aristocracy and others, when they started getting stressed, they said, "Hey, these people are conducting all this trade, and it happens outside of a mechanism I can tax."
Yeah.
Because they were taxing the specie.
Yes.
And and so
this is the yardstick thing, that if it isn't priced relative to the species, you don't know how to tax it.
Yeah.
As a result, it's hard to tax, and
it's
nobody
hard to
wants it to be
tax.
hard to
Yeah,
tax.
exactly.
So it's a measurement problem that forces us down that track.
Right. Well, that's one of the things. But that's a big one because people, being the ruler started costing a lot of money. You had these lavish parties, incredible lifestyles. You had to basically, subsidize, and you had a higher cost.
Yep.
As there was more and more.
It's good to be the king, but it's expensive to be
But it's
the king.
expensive. That's right. And so that led to this single system. Prior to all this, though, there were lots of assets that weren't really valued. So, like property, when you were a lord, you won property not by buying it, but by doing some favor for some ruler, or by
you go off to battle and you come back and they give you a castle.
and they will give you a castle and all the lands, and you can basically
So it
have
never
that.
winds
So
up as part of the cash economy, so it's unpriced.
it's unpriced, and so and then you have all these new asset classes that have been created, that we've created in stocks and bonds and all these other kinds of things, for which there never really was currency in the first place. And so, what's happened, and then you have appreciation of value too in these assets that is disproportionate to currency. So you have assets that were never bought by anybody that end up having them, like assets that were like in the United States, where we gave away plots of land all over the United States. If you just would go and basically build a house there and live there,
Yes.
you would homestead it, and then you would just get given it, right?
And it never passed through a valuation step.
There's no valuation step. So it never really had to have money originally in order to get it.
Wow, okay.
And so what you were doing when you're doing this is you're actually creating money, but in a sense, because you're creating value, right? So you're creating value, but for which there's not enough money.
So you're adding value to the
Into
system
the economy, but
without increasing the
money in circulation to do it, right?
Right. Got it.
And so that's just wider than it it has ever been
Yeah.
right now.
Yeah, yeah.
And governments know this, and I mean, this is the primary reason the United States, Nixon deregulated the dollar, disconnected the dollar from the gold standard, is because, and thank God he did, because it would have, there wouldn't have been enough gold to back the dollars that we need in circulation today.
So let's talk about the gold standard,
Yeah.
because it's a term that people use without really understanding it.
Yeah.
So my understanding of the gold standard is that for a chunk of time, and I'm not sure when it begins,
Yeah.
but for
1880.
1880.
Yeah.
So there's about a 100-year period, 1880 to
No, it's actually
1970?
1880 to 1917. But
1917.
yeah.
Oh, 27 years?
Yeah, that's it.
I thought it was Nixon that ended the gold
Well,
standard.
he did. He ended the gold standard, but the currency entirely being backed by gold certificates
Yeah.
ended in 1917.
Okay, so for that window, every US dollar was backed by a certain amount of gold, and you could literally go to a bank, hand them your currency, and walk away with literally coins.
Yeah, that's what they said.
Yeah. Same thing was here, right? A pound was said to be a pound of gold,
Right.
and that ran for a while.
Right.
So prior to that, you just didn't have banknotes that were issued by a central bank?
Yeah, you had, well, you might have had, there was like continental currency in the United States
Yeah.
and whatnot, but you didn't have you didn't have, that wasn't specie. That was just kind of like a different kind of banknote.
Okay.
It was kind of like the governmental version of a banknote.
Okay.
And it was backed by tax versus being backed by, backed by specie.
So the paper currency was kind of softer at that point, then it goes on to this gold period, then it comes back off the gold period.
Right. And that
So the
was
gold-
an attempt
so the
to
gold
solve
standard-
problems.
So the gold standard was an experiment.
It was an experiment, and it's an experiment that's, I think, many economists consider to have been a failure.
Yeah. Well, I mean, if it only lasted 30 years in that form, you get the feeling it
Yeah,
wasn't working
and I
too
mean, when I say that, I'm being kind of really technical, because from what the average person understands, and I didn't even know this, it wasn't until I started talking to, one of our economists on our advisory committee that I actually learned this stuff. So, if we hadn't disconnected the currency from the gold standard in the United States, what would have happened is it would have continued to basically create a dampener on the economic growth in the United States, and there wouldn't have been enough
Just
liquidity.
because of lack of liquidity.
Just because of lack of liquidity.
So there wasn't enough currency.
There
The
wasn't.
economy is growing. Everything is being
Yes.
continually priced because there isn't enough currency to go around.
That's correct.
Deflation.
Well, and what that did is it basically means that the problem with a currency being pegged to something like an asset is that if the asset's appreciating, that means the currency itself is appreciating.
Yeah.
And that means that I don't want to spend it because it might be worth more next year than it is now.
Bitcoin, right?
Bitcoin.
Yeah.
A perfect example.
Bitcoin is only really exchangeable for Bitcoin because at the end of the day, nobody wants to take it out for anything.
Yeah, I mean, I own Bitcoin. I don't ever want to sell it. So the idea of wanting to go places and buy stuff in Bitcoin, I don't ever want to do it. Even though I visit places that will accept Bitcoin, I
Yeah.
even have conversations. I'm tempted sometimes to buy stuff with Bitcoin. I don't do it because I think, well, it might go up more. Typically goes down the next day, but but in general, it's gone up. It's gone up. So that's the problem. And so what you want in a liquidity mechanism inside a society is you want as much possible liquidity, and the reason is it's something that people just don't get about economics, and it's really a fascinating thing because I didn't get it about economics. So if I give you this £5 note, okay,
very much.
how much did you just get?
Well, £5.
Right now, if you give it back to me, how much money circulated in the economy?
Well, £5 each way, £10.
£10.
Okay.
So part of what happens so what you want in an economy is you want velocity of circulation of the currency.
Right. So when you need money, there is money, and you pass it in, and you pass it.
and you
in,
pass it, exactly. You don't want
Right.
people holding on to it because they think, oh my gosh, this £5 might be worth £10 tomorrow.
Right. Absolutely.
So
Because then you need more and more and more money to maintain the same amount of liquidity.
correct. Well, and then people don't buy.
Right.
And because they don't buy, then there's not a turn. Yeah, so the things that grow
metabolism
economies are the number of turns that happen of the currency within the economy, and increases in true efficiency. So the price of something actually decreases for the same amount, for the same thing. Those are the two
Right.
things that grow economies
Wait.
reality.
So what was the first?
The number of turns.
Okay,
So,
the
if we
velocity
can make
of
the velocity of the money move faster,
so velocity of the economy and a drop in the price of fundamental services.
it increase in efficiency. Prices can be manipulated.
Okay, so efficiency goes up or velocity of
the
money
velocity
goes
goes up, the economy
up. So
grows.
more stuff happens faster or stuff happens more
Yeah, that's what
efficiently.
makes GDP grow.
This is
okay?
the actual, okay.
Yeah, right.
So that's
So-
the real basis of growth.
That's the real basis of growth. So what you want is you want the economy to grow, to turn as much as possible.
Yeah.
Okay. And what happens in situations where money is scarce or where it's difficult to get money is people hoard it. Because they're afraid they won't be able to get it again.
Right,
Right.
right,
So
right.
they don't trust that they'll get some more tomorrow.
So
You know,
end
we
up
don't
with-
feel that way in industrialized environments where we're professionals and we make a bunch of money. We go out to the pub and we.
But like Japan has crazy high savings rates
Yeah.
because it's been a hard culture for a long time.
Exactly.
It's been very hard to make a living because it's a tiny island and a lot of people.
That's right. And so those kinds of things drive, this behavior. So if you, in global trade, where this is an issue, is that the money has to get to, has to go from the big company down to the mid-sized company, down and down and down, down in this thing we call the supply chain, to eventually get to, some farmer, in
Right.
in Vietnam or something, who actually raised the rice
And if the money
that
is
I'm eating here.
deflationary, it won't make it all the way down the supply chain because everybody has more friction before they're willing to spend it.
Yeah, and so most nations, most industrial nations today, actually want to see a little bit more money added to the money supply every year because it devalues the currency a little bit, like 2%.
So it just encourages people to spend.
Well, because
little.
that's enough. They feel that it basically encourages spending, and you don't want spending to be careless. You don't want it to be just crazy, because that can then create inflation. And so that you're trying to balance that, but you're trying to balance it with one currency. And if you have two currencies, you can balance the currency used for assets separate from the currency used for liquidity. And this is what the world did mostly for most of the global history, and we
Right,
basically
right.
went away from for a while, which was an experiment.
Yeah.
And it's just not as good as people now recognizing, I think, in general, well, the average person, but it doesn't maybe, but many economists do,
Yes.
that it'd be better if we could basically go back to a two-currency system.
Yeah, and this was Later's whole thing about future money, just pointing out that all of the most productive economies in history
Yeah.
had a hard currency and a soft currency
Correct.
operating as pairs.
Correct.
And
So-
that was the historical norm for efficient economies.
So the blockchain introduces an ability to now disconnect these things in a very credible and real way.
Because you can just make currencies that will operate correctly.
From watts.
Right.
You can create currency just out of a bit of electricity.
Yeah, what about mining? Boom, there's your currency.
That's it.
but how-
And now the other thing that it does is it can enforce rigorous rules
Yes,
about the creation of currency.
yes.
And so, and oddly enough, you can go back to asset-backed currencies that are backed by lots of different kinds of assets, not just by, say, gold or something.
So the rigorous rules is easy, right? I mean, you have the blockchain, it's a decentralized network, everybody's running the same software, they have to make a coordinated change, otherwise the thing doesn't correctly register. So that's your framework for the rules.
Yes.
That part makes sense. But how do you use that to issue currency that isn't just, mined tokens that are coming out of cyberspace?
So what you have to do is you have to take either some kind of asset, and do what banknotes used to be, or
Okay.
what marketplace script used to be, which is some kind of asset or commodity,
Okay.
which is a type of asset that you put into into the bank.
So I come
And-
to you with a case of whiskey.
Yes.
So in the oldest, most archaic system, you'd write me a note that says, this is worth a case of whiskey, and you'd give it to me.
Yes.
Right,
Or,
so
or it would be, I would put some value on that whiskey in terms of my local system,
Yeah.
and say that whiskey is worth so many loaves of bread, or whatever the local
you could
trading
have-
mechanism was.
So you could have an economy that was priced in fish. So I would bring you whiskey and you price it in fish.
Yes, exactly.
Right. So whatever we produce locally is what we'd use as yard of value.
These are pawn shops, right? So, that's,
Okay, right,
But
yeah.
just but
Simple
but
enough.
That's kind of a one way to think of it. So you get the asset, put into a safekeeping,
Yeah.
and you get this script, which you
Right.
can then use, and you have to bring back the same quantity
Right.
of that script when you come back.
So
after
keeping-
all the exchanges you've done,
So
to get it back.
So managing all the script end of this, all the things which people are issuing each other, the promissory notes.
Yeah.
Perfect fit for blockchain.
Yes. Perfect.
Right,
fit.
because you've got tons and tons and tons of funny-looking pieces of paper, and if you lose them, you lose your money.
Yep.
Well, let's stick all of those in the wallet, and everything will be much more peaceful.
That's right.
Okay, so
And-
the core that part of the mechanism makes perfect sense.
Yep.
So who then is the entity that I bring my case of whiskey to in return for a bunch of this funny money?
So you obviously can't take a bunch of whiskey and put it on the blockchain. You have to take a
True, unfortunate, but true.
But what you can do is you can take and lock that whiskey up in a legal document
So
that
I write-
passes title of the whiskey
Yeah.
in a storage location that is trusted, like a bonded warehouse or something.
So I write a piece of paper that says, you hold on to this whiskey for me and you don't give it back until Bob says so. And I hand it to you by putting it in a physical bonded warehouse.
Yes,
So I'm now
that'd be
using
one example.
So I've now got a whiskey-backed currency 4x12 bottles.
Now you have your whiskey-backed currency, but you don't really need bonded warehouses for lots of things, and you can do this in the real world because banks and other things have learned how to do this over time.
Well,
so
I only need a bonded warehouse if it's a low trust environment. If I promise
exactly.
you that I'm not going to drink the whiskey, I might as well keep it in my bedroom.
Well, except we can't trust you. You see, that's the problem. But so what you have for certain assets, like say real estate, it's easy to understand for people.
Yep.
It's pretty easy to do because there's all sorts of systems in much of the world to identify the title and whatnot. There's certain countries where that's not true, but
But in
you
the
have to
places
use-
where you've got strong land rights.
where you have some strong land rights and you have a history of title. There's usually a title registry and
So
whatnot.
I own my house, I can prove the fact I own my house, it's on the title registry. I come to you and say, right, take these deeds
Yes.
and in return you will issue me a chunk of promissory notes.
Yes, and the promissory notes now can be something which, once the house is put into a place where the title can be placed on the blockchain
Yep.
with the proper legal structure to allow it to have titles transferred if you don't pay back your debt,
Yep.
you can actually now allow you to borrow from you off the blockchain by minting the currency.
Wait, hang on. Me to borrow from me?
Yes.
Okay, I didn't understand. I did not understand that.
Okay, and that's this is the crazy bit about the blockchain.
Okay.
Is that I don't now need a bank or separate intermediary. I needed one to basically secure the title, but that was just to get it on the blockchain.
Okay.
Now that the title is on the blockchain, though,
Yep.
the blockchain infrastructure itself means that I can actually put that title in a smart contract,
Yes.
which says I can't get it back unless I pay back the exact amount of currency, of tokens, that I get when I put it in.
Oh, okay. Hang on.
Okay.
Let me take this real slow. So I take my house title, I put it in some kind of legal structure that means that I can't
Can't sell it.
can't sell it until I've put the tokens back.
Yes.
And so the smart contract takes back the tokens that it issued, and when all of the tokens have been put back into the smart contract,
Once you put them all back.
my house pops back out again.
That's exactly right. You get
Okay.
the title
So it's
unlocked.
banking without a bank.
It's banking without a bank. And you're using, almost all forms of asset-based lending can be done this way.
Okay. So something peculiar happens here. So, and I mean, I think this is actually a fundamental mystery of the way the world works. So I take an asset, I put the asset into this legal container.
Yep.
From this then are emitted a set of tokens which represent the value of the asset.
Yep. Right. Will represent the collateral value,
Yeah.
which is not necessarily its market value. It would always be something less than that.
Right, but
That's
it's
why
its
you don't
value-
get a mortgage on your flat
Yeah.
that's equal to the price you had to pay
So
for
this
it.
is the secured loan kind of value.
Yeah, yeah.
But in this instance, the currency which is being issued is not fiat currency that was originally issued by the state against tax revenue. It's new currency that's being issued against the value of the house.
That's correct.
So rather than backing the currency against gold, or backing the currency against future tax revenue, or backing the currency against the artificial scarcity of Bitcoin or Ether, we're now issuing a cryptocurrency which is backed against the physical assets
Right.
of of a society.
Yes.
And the physical assets of the society are 10 times the size of the financial assets.
Well, not of all
Or at
financial
least the
assets, of just
currency.
the currency, yeah.
Okay, so what we're talking about is being able to use all of the assets of a society as ways of backing currency to provide liquidity so that the economy can go faster.
Yes, and you didn't have to rent the money from somebody else.
So that you're not paying interest, but you
don't
might
need to pay interest for
because
that.
because you're borrowing the money from yourself.
That's correct.
Or at least you're printing your own money relative to the backing.
Yeah, and you'll lose your asset if you don't repay it.
Hang on. So this sounds a lot like we kind of start with 2 goats and then we get 5 goats and we didn't have to pay for 3 goats. Are you sure this is okay?
So this is actually how banking was done for 5,500 years. And it's still, so the only difference is that in these bank systems where banknotes were created, they would charge fees. And we have to charge fees as well.
Yeah.
But the way we handle that is we have 2 classes of individuals. We have individuals that are kind of members of this new economic system,
Yeah.
and individuals who are just guests.
Yes.
And if you're a member of the economic system, you buy a membership, and that membership allows you access to things where the fees are covered and paid for. They're basically free.
So your KYC'd, your AML'd, you're checked into the system, you've had your background checks done, whatever it happens to be.
Whatever happens to be.
I come with assets, and so how do I know how many coins, whatever it is, I'm going to be issued in exchange for the thing that I bring into the shop?
Well, the system actually uses markets for whatever the class of asset is to value the asset.
Okay, so you look at the price of the houses that are similar to mine.
Yeah, houses need to work differently in different legal jurisdictions.
Okay,
so
okay,
let's
so
do
let's-
something easier to understand for people
so
easily.
I've got a bucket of gold bars.
So let's use gold because their gold is traded in commodity exchanges or any
So
commodities.
I
on
come
an
with a bucket
exchange.
of gold and I make a credible promise that I'm not going to sell it.
Well, you'd have to actually put the gold into some kind of custodial vault
Yep.
that would actually store the gold. Okay.
From that, I then receive a set of tokens which are related in value to the price of gold at that point, minus some
correct.
custodial fee and all this kind of stuff.
Yep. Unless you're a member, in which case the custodial fee is waived.
And then I have this set of tokens, and those are exchangeable for anybody who will accept them, who knows that they're backed by my need
Correct.
to get my gold back.
Correct.
Okay.
And that means that the people that get it could basically anyone who will accept it, and that's how banknotes worked in environments. But not only does it work for anyone who accepts it, so you don't have to just stay by trading with these tokens. You can actually exchange those tokens on exchanges to convert them into some other token or fiat or some other commodity.
Okay. So I've got a bunch of steel in my warehouse and I need to buy paint to cover the steel before I can sell the steel to the guy that I'm selling the steel to. I borrow money on the basis of the steel that I own to buy the paint. I paint the things, I sell them to the guy, then go and get my tokens back out of Hulk.
Yep. Okay. Well, in fact, you can't conclude the sale until you do.
Right.
And so what you're enabling now is for commerce to happen without a need for people to actually have possession of fiat currency for it to start.
Okay, so let's go back up a step to this world of the kind of 90-day invoices.
Yep.
So you talked about the situation where A was going to pay B, was going to pay C, was going to pay D.
Yep.
And if it all happens in the right sequence, everyone is happy.
Yep.
But if it happens in the wrong sequence and C needs to get paid by B before B has gotten paid by A, B has to go to the bank, borrow a bunch of money at 20% because they live in a poor country, and as a result, the whole thing breaks down and the bank winds up eating the system.
That's right.
So in those instances where I've got outgoings that are going out before my incomings, but I have assets in the middle, this is where I borrow.
That's it. In fact, you don't even think of it as borrowing in the classic sense, because you don't have. You're just getting the ability to get liquidity from your invoice or from the order.
The assets I have.
Yeah, which are earlier than you would if you waited until the customer paid for it.
Right.
So when the customer actually does pay for it, I don't actually get the money. I get the money earlier.
Yep.
And I get it in these tokens, which if I'm in a supply chain being anchored by some megacorp, let's say, I can then pass down to my suppliers, who pass down to their suppliers, and the entire system is anchored by, some large entity.
Right. So you're
But-
selling me coffee beans,
Yep.
knowing that I am then roasting those beans and selling them to, McDonald's or Starbucks or Nero
Correct.
or whatever. So
Correct.
you know that they're going to pay me eventually.
Well, you don't need to know that.
Okay.
The blockchain can actually just be the entity that knows that.
Yeah, sure.
So
the proof that I've been paid by these guys every month for 5 years is on the blockchain.
Yes.
And you're basically lending me money against that proof.
And it's not just the proof, it's the fact that the order actually comes from this entity, Starbucks,
Oh, so you
Okay.
can see it all the way through.
all the way through down to the farmer. You see, so now what happens
So the
is,
transparency along the blockchain is used to de-risk the lending that happens in the context.
so let me put this in precisely right. So let me put so. Remember, we said that
This is-
commerce is 54 trillion of GDP. So
Yes.
GDP is profit.
Yes.
Okay, that's what
Yeah,
that's
yeah,
what it
yeah.
is. It's an increase in economic value. Okay, so it's profit. So the actual dollar value of all the transactions is larger than that.
Yes.
Okay, so this is profit. There's $54 trillion of profit.
Yes.
That's far more than enough after all the failures, all the disasters, all the hurricanes, all the volcanoes,
So when
all
it-
the
so when
destabilized
it's
nations,
all-
all the failed
Right.
businesses
So when
after.
it's all netted out,
It's all netted out. There's still 54 trillion,
left
right?
over. right. So you can
there,
absorb.
you can basically you can manage all the counterparty risk in global commerce by global commerce without any assets.
So even if it all goes horribly wrong, there's still 54 trillion left over.
That's it.
And at that point, it ought
That's
to be
it.
enough to carry itself over any little bump.
That's exactly right.
That's
so
completely insane. Wait a minute.
It
on.
is insane.
Why
but
are we not doing it this way already?
because we never had an ability to do this at a global scale first, and we never had the ability to actually know
So-
what all the different ins and outs of the the revenue and the expenses or increases in liabilities.
Yeah, okay.
You know,
Have you heard the term economies of omniscience?
yes.
Right. So what it sounds like you're basically talking about here is economies of omniscience.
Yes.
Because we know so much about the profit and the loss of all the entities
Yes.
involved in the supply chain,
Yes.
that allows us to lend money at very low risk because we know that they've got outstanding invoices to entities that we know are going to pay them.
Yeah, so exactly. And so since I know that
And the loans are fully secured against assets.
what it means is you don't need to secure them as much by assets as you grow a network that actually understands how. So I can actually. So this means I can use the assets
Oh,
for.
wait. This is what banks used to do when banks actually understood their customers.
That's it.
There was a bank manager who knew things about you and knew the basic shape of your business, and knew your business with health, and would lend on the basis.
Yes.
Then they take all the brains out of the branches and the whole thing is done at HQ, and then they stop lending.
Yes.
So what you're saying is that basically, if you've got enough access to the actual transactional data, because it's all on chain, you can then lend against that.
And it's not just the information. If the chain is actually conducting the settlement,
Right.
then
Then you can see the incoming payments locked up in a smart contract waiting to be dropped.
right, and you can reroute them around bad actors or failures to the parties that they're defrauding. Now, what this allows you to do is isolate risk. So today, another reason there's interest in the system,
Because nobody can run off with the money.
nobody can run off with the money.
It's all locked onto the chain.
It's all
so
locked
something
into the
goes
chain.
wrong
That's
and you-
exactly right.
Wow.
And yet they have money.
This
okay?
is like the operating system for Star Trek. I mean, this is fundamentally some kind of new
Well,
economic thing.
it's what. So some of the writers that were part of Star Trek, I think, actually were influenced by some economists who have actually written about the possibility of doing this for
Okay.
a long time.
So, what do those economists call this? Like, what are we actually looking at here?
well, it's called lots of different things. I think the way it's been envisioned by a lot of different economists isn't exactly what I think we're going into. Just like a lot of futurists predict things that we
just kind of
predicted Dick
noodle-
Tracy on the the phone, kind of thing.
and it turns out
and it
watches
turns
are too
out it's this
small.
little bigger box because
Watches are too small and you
it's
kind
too
of
small.
bad ergonomics.
Yeah, exactly. It's not really convenient to hold it up to your ear.
Yeah.
So some of the things that we envision when we realize the implications of technology or that there's a better way don't end up actually coming out quite the way we envisioned them.
Yeah.
And I think that the blockchain implication is that we can do some things that would have been kind of difficult for people to actually even believe
sure,
would be doable
sure.
because you didn't have this ubiquitous accounting system.
I mean, we're on a branch of history that's totally outside anything that I read in the science fiction when I was growing up.
Yes.
Like, people think we're kind of in a cyberpunk real world.
Yes.
But actually, the anonymous digital cash stuff was never understood in cyberpunk. That was not part of the mythology.
Exactly.
It's a totally different branch.
It's a totally different branch. And
So if people are interested in the underlying economics, what kind of stuff should they be reading? Like, is this resource-based economics, or who are the economists that people ought to be thinking about taking a look at?
So there's lots. Okay, there's the economists that have talked about like gift-based systems. There's
Yeah.
LETs, which are local exchange token systems.
Yeah.
There's things like the Bank in in Switzerland
Yeah.
that's been around for 60-some years. That's tokenized, mix of tokenized via
Lots of
currencies.
token lending stuff.
Yeah, there's lots of token lending stuff. There's distributive economics out of the UK here.
Yeah.
There's lots of different stuff out there, but
I mean,
none of it has been developed in light of the knowledge of what the blockchain means and applies.
Right, because if you don't have a blockchain, you don't have the kind of underlying systolic system that's moving the money around.
Correct, and so you end up with a lot more artificial mechanisms that people try to use kind of social engineering or government to try to solve problems that you don't need.
Right, so what we're looking at is a collapse in complexity because the map of the system is now identical with the system.
Correct.
So you can do symbolic operations on the map and it directly changes the territory.
That's exactly
And the whole thing just collapses to
The
be
whole
one
thing
layer
just
thick.
collapses,
Bing.
right.
And all of your complexity from binding the two levels together using law and enforcement and police and all the rest of that just goes boom.
And this has lots of side effects that we think will benefit even governments and whatnot because
Well, I mean, if you were running an economy that did a lot of manufacturing, suddenly the manufacturers are no longer bottlenecked by their access to capital.
that's it. Wait,
hang on. Let me see if I can get the next bit myself.
Okay.
So we've got these assets which are only 75% utilized.
Yes.
And the assumption is that if they've got a lot more access to capital,
Yes.
they could go from being 75% busy to being 95% busy.
Well, not just because of that, but because you also end up, when you do the accounting to actually know how much these things are used,
Because you can see exactly what's
you can
idle
see
and
what's
not.
actually underutilized.
So you could basically map all the underutilized assets and then provide liquidity to actually get them back into production at any given time.
Well, you can actually do something quite astonishing, which is you can actually switch
Wait,
from...
this wasn't astonishing already?
Well, so you can do what you just said, but that's kind of an unnatural state of a system that has this level of transparency.
Okay.
And let me explain it with a story. Sales. Okay, we take sales and marketing for granted.
Sure.
But it didn't exist until the 1880s.
What?
So sales only...
What? What are you talking about?
So sales as a company organization didn't exist until the 1880s, and I don't remember the name of the company. You can look it up online, but there's a obscure company that did it for the first time, and it was a side effect of centralizing production. So when we centralize production, and we're not making stuff in the local village, you now have to actually tell people about what you are making.
Because they don't know anybody who knows anybody who knows anybody who knows they're making stuff.
Exactly. So you have to actually get the message out.
Yeah,
right?
yeah. And this is like looking at stuff, going back to our kind of archetypal medieval village, you know the guy who's making shoes, so when you need shoes, you go over and talk to the guy who makes shoes.
Right, because you know he's the guy that makes shoes.
Right, but now you type random search terms into eBay, and you'll see like stuff manufactured in Shenzhen, and you don't even know what the object you're looking at is. Like, what is that?
So we needed sales to tell people about stuff in different geographies. We need marketing to tell people about stuff that didn't know about it, okay?
Okay.
So when you have ubiquitous information...
So sales and specialization go together.
Sales and centralization of production go together.
Yeah.
So, as well as, kind of non-localized, things. You need sales to basically communicate or marketing.
Yeah.
And so when you can now find stuff easily because it's all transparent, okay, the problem changes. So instead of the problem being, I don't know which stuff to use,
Yes.
The problem is now I'm overwhelmed with all the choices of what I could use.
Okay, so the discovery problem goes from I didn't know they were making it because I hadn't heard the news to now my inbox is 750 million items and I have no idea what's out there.
Right, so
I
you can
can't-
imagine what would happen if everybody started broadcasting out all the information about all these underutilized assets.
Right.
People would just be overwhelmed.
Right, because
Okay.
you'd have 25% of the economy demanding attention.
Yes, the signal.
Hey, I have this grain mill, I'm not
the
really
noise
getting
to,
rid of it.
the noise level would just be impossible to
Yeah,
absorb.
because it's a quarter of the assets in the economy that are squeaking to be used.
Exactly right.
Which is
So-
bonkers. This is insane.
So that won't work, right?
Yeah,
So
yeah.
what has to work instead is you make instead of today, the asset, the company that has the asset tries to find the business.
Yes.
You make it so the business tries to find the asset.
So I say I need this service, and then I can index somehow or other to find it.
Well, you can index to find it, but where the equivalent of sales now becomes a role that actually works for you.
Okay, so
the
this is
consumer, not for the producer.
So this is what they call VRM, vendor relationship management.
That's exactly right.
Which involves the idea that instead of I advertise my needs, and then the people who want to meet those needs come and find me,
Yes.
and the whole thing is coordinated through software which operates under my will.
And it can, if it's on a blockchain, this is now publicly available, right? So it's now.
So I publish what I'm looking for,
So-
and your software finds out that I'm looking for it, and then tells me that you've got it available.
Well, and you'll still need experts to figure out whether or not that's actually the right thing to do.
Yeah.
Okay, so you might not be able to get all the warehouse space you need in downtown London
Right.
in one place because the utilization of the warehouse is going to be split across three separate places.
Yep.
And you might not have the expertise to know that what's the best way for me to do this, but somebody else does.
Yeah.
And so you have somebody else who does that for you on your
Yes.
benefit.
Right.
And that actually makes things work better.
Thin sliced expertise is a service to act as a buffer all the way through.
And so as you end up having this information, what happens is sales. The thing that's inefficient about sales now is that if there are three companies trying to sell you and they each spend 20% on sales, that's a 60%.
So the number of failures
The
in
number
the
of failures.
sales
So two
process-
companies spending 20% on sales make no sale. One is spending 20% on sales,
and all that
makes no sales.
dead
That's
loss,
just waste.
and it's a dead loss for the economy.
It's a dead loss for the economy.
So if you reduce the effort being used to make sales, it then again fundamentally increases baseline economic efficiency.
And you get rid of this kind of artificial need to try to sell you things that you don't really need.
You know, we've been talking about this stuff off and on for a month, and
Yeah.
I think this might be the first time I actually understood it. So what you're talking about is a set of optimizations which might be worth like 30% of GDP globally.
Yes.
Whoa.
Yes.
Right. Yeah, that would explain why I'm a little lightheaded. I kind of feel like we should have two red armchairs, and you're like, now do you see the Matrix? The Matrix is made of waste.
Which pill do you want?
The red pill, right. Okay, so we're going to go and kind of pull back 30% of the GDP from underutilized assets and unnecessary
So
borrowing.
it's not going to
and all the
happen
rest
like
of
that
stuff.
overnight. And,
No.
And you're never going to optimize all assets because you need waste in the system, just like your body needs fat.
Yeah.
So when you can have excess inventory in the system, you don't have to over optimize the actual things, so you can put things in places that would be maybe more costly if you had to pay for cost of capital for things like inventory. And you can make better choices in things like transportation.
Yeah.
So this is very important for things like carbon footprint, for finding ways to reduce waste in the system. And if we don't have to move everything in a rush, which costs more, burns more energy and whatnot,
Yep.
we can actually do things more efficiently.
Yeah.
So a little excess inventory, like a little extra fat in the system,
Right. It's economically optimal
is
to have a bit of slack.
economically valuable to be able to do that.
Yeah, that makes sense.
And the cost of energy, the cost of holding inventory, the penalties companies get from analysts and whatnot from having a lot of inventory in their balance sheet has forced us into an environment where we basically ignore some of these things,
Right.
and we end up burning up more energy, we end up burning up more cost
Right.
related to the logistics.
Iatrogenic medicine, they try to push for efficiency, but they actually create inefficiency.
Yes. Yeah.
Interesting. So, I mean, The overall thing that I'm seeing here is basically a restructuring of the economy based on better access to information.
Yes.
Right? And what you're talking about is basically an economically productive path for that restructuring to take place.
Yeah.
So we might say that there's a kind of an inevitable end state where all the stuff is instrumented, all the stuff is documented, and everything is produced where and when it's needed. But the path between the current economic equilibrium and that path, there could be 50 different tracks to get there. And what you're proposing is a path which is basically driven by liquidity provision inside of existing supply chains.
Yes.
So you take an existing supply chain, you instrument the supply chain using the blockchain, you then provide a bunch of additional financial services along that supply chain which make it more liquid, reduce the capital costs, reduce the dependence on external borrowing, it becomes more efficient, and as a result the competitors then have to adopt the same practices. So this is kind of the dike which you figured out exactly which brick you pull out.
Yep.
And then from there we get kind of lifted into this new equilibrium condition.
Right. So this giant, kind of change we're talking about can happen and be powered by very small changes that occur in ways that are very self-interested.
Yeah.
People have tremendous, I want to make more, I want to have a higher profit,
Yeah.
I want to spend less.
And it doesn't rely on complex multi-party coordination
It doesn't
to do
require, it can happen a party at a time.
Yeah. Yeah.
And the thing that gets people to make the change
Yeah.
and to adopt the new system is free loans.
Right.
So if I can get money for free,
Yeah, you could pay 7% or you could have it for nothing. Which are you going to pick?
which would you pick?
Okay. So
And that starts the snowball rolling.
yes.
Then as the track as a condition for getting this is to adopt a settlement process where the expenses, revenue, changes in balance are recorded in
Yes.
a accounting system on
Yes.
in a ledger on the blockchain.
Yeah.
And the changes in liabilities and assets also are recorded there.
Okay.
As a
So
prerequisite.
this is the instrumentation step.
The instrumentation.
You have to instrument it before you can optimize it.
Well, the first thing you do is provide free liquidity.
Yeah.
Okay. Then, as a precondition, you ask people to adopt
So
the.
if you instrument your economy, you can have some free loans.
Yes.
Okay, so that's
Well,
a pretty strong incentive to instrument.
Yeah, without as much assets.
Yeah.
So I can now reduce the amount of assets I had to tie up for using to get liquidity for my supply chain.
Yeah.
And I can take the same assets.
right.
And I can use the money now for investing in R&D.
Because the more information you have, the easier it is to make a free loan.
Well, it's not just that I can make the free loan, it's that we can actually now manage the counterparty risk that you're managing with assets
Right.
against the other counterparties in your
So you
supply
don't,
chain network.
you don't need to keep a big buffer because you control exactly how far
Right.
the car.
And
This reminds me of road trains. They talk about self-driving cars.
Yes.
You'll be able to drive them bumper to bumper around freeways for super efficiency.
Yes.
Because it's basically fly-by-wire.
Right.
Same kind of
Same
thing
kind of
for
thing.
supply chains.
Exactly.
Basically, everything is coordinated.
And
dovetailed.
what happens is that people that adopt this end up becoming more competitive.
Yeah.
And oddly enough, it's actually a system of cooperation.
Yes, absolutely.
So it's a system where all the parties in the chain
know-
actually win by cooperating better and more tightly.
Yeah, you know this thing that I wrote a couple of years ago, dog atheism?
Yes.
So
Yes.
dog atheism is like this entire thing written in crayons by somebody that had never seen an actual supply chain. So I've had this kind of dim intuition that you could take everybody in the supply chain, you could line them up, and you could interconnect them, and they could share profit down it. But it doesn't have any of the the actual nuance. So I recognize what I'm seeing, but I could never have created it. But it's amazing to actually see what it looks like in the fully rendered form.
And so what we're seeing now, and this is what I don't think many of the enthusiasts in the blockchain community actually have seen, is that we're seeing that we're now joining economics with code and with law in a way that allows us to actually change the rules under which we actually do things, and we can make substantial improvements in society now without requiring political will to do it. And in fact, we can actually help finance the process of doing it in ways that cost governments nothing, but increase their ability to generate revenue and income for themselves.
I mean, this is the better mousetrap, right? You've found a way of taking some of the stupidity out of the economy. Everybody benefits from it, but it's not a political change, even if it solves political problems.
That's right. And in fact, we don't need to kind of overthrow the whole system and try to kick all the people out and whatnot. We don't need to do that. All we need to do is basically work within the existing frameworks and just do a better job of it.
Well, I mean, this is the free lunch part, right? So the free lunch part is that there are some problems you can solve without requiring political change. It'd be nice if we solved those problems. There are other problems which will require political change, but maybe that's tomorrow's problem.
Well, and maybe the way of looking at it is that we now have an opportunity to do, so we primarily needed government's help because we needed people to be regulators who would pass laws that say you have to do things these ways, and would create the policing to make sure that happened.
Yep.
We don't need that. The blockchain can do that,
Right,
and
right.
the
Because
contracts
you've got
we
the
enter into can
transparency.
use the existing legal system to help enforce it.
Yeah, absolutely.
And so we do this commercially. It can happen far faster. You don't need to worry about the differences in factions and what they think politically.
Yeah, no, because this isn't a political change.
It's not.
Right. I mean, it's like electrification, right? Electrification might have required a bit of political support in some places. It might have wound up as a political priority, but at the end of the day, it was not a political process.
Yeah, and I'm not saying there aren't things that politics could bring to the party that would help improve it.
Yeah.
It's that we don't need to wait for that, and we don't need to depend upon that.
Well, I mean, a lot of problems go away if your economy gets 20% more efficient. You know, that pays for your national health service, it pays for your education.
If your party's in charge when that happens,
Yes.
you get a lot of credit,
Everyone would be very
even though you had nothing to do with it.
Very happy. Yeah.
It's very popular. Nobody likes killing golden gooses.
So we've talked about this stuff at a very high level. We've gone deep into the theory. Blockchain stuff, I mean, is very much in the shadow of Bitcoin, right? Bitcoin came from libertarian political theory, to some degree anarchist political theory. It was explicitly about the formation of money. Yeah. But it didn't really deal with trade, it didn't really deal with manufacturing, supply chains, capital, none of that kind of stuff. So the blockchain kind of theory, the ideology almost, has always been very, very, very much targeted just at money creation, and at money creation as Bitcoin instead of fiat.
Yeah.
So what you're talking about is an alternate approach to money creation within a very, very tight sector in which it's really just liquidity inside of quite well understood supply chains. It's not like printing money in the abstract, it's liquidity in the particular. It fits into no particular political structure, it's just an observation about the efficiency of trade.
Yep.
But it does seem to have a certain kind of world-transforming pattern to it. What exactly is the launch procedure for this thing? You know, I know you've got 2 decades of experience in supply chain. You really understand that side of it. You've deployed all kinds of advanced technology in the past. But for this Sweetbridge project now, what's the sequencing over the next kind of 6 months or a year to take this enormous, complex abstract theory and turn it into, services, boxes, product on a shelf?
So the very first thing that we need to do is to release the mechanism that allows you to actually use a phone and a digital asset that's on the blockchain. Mm-hmm. And on the phone, basically say, I'd like to borrow this much money for this much time, and I'd like to do it as a balloon payment, or I'd like to do it as an amortizing payment, and you pick what you want to do with your asset.
So I take some Bitcoin and I basically
use it as collateral,
put it into the Sweetbridge system.
And do that.
So step one, it's pure digital. It's very simple.
Pure digital, very simple. It's a proof of concept. It demonstrates that this all works. And what seems like fantasy, the ability for me to lend to me.
Yeah.
How can that possibly work? How can I trust that? The average person isn't going to understand that because they don't understand.
But you try a couple. I mean, this is like our camera app, right? It's the thing that just proves you can do it.
It proves that you can do it. Okay. As soon as you can demonstrate that works, you can now you can start scaling this up very fast. In fact, the demand for scaling this up becomes, I think, quite large.
So you scale horizontally by saying, okay, we could take Bitcoin, we could take Ether, now here's some other
Now we're going to do real estate in Arizona, we're going to do real estate in London.
So you incrementally add different kinds of assets that you'll allow people to borrow against?
That's it. And commodities, we're going to do rice in Vietnam.
So it's literally just incremental growth.
It's just incremental.
So as soon as you could build a legal way of accessing an asset,
that's it.
The asset becomes part of the system.
It becomes part of the system.
And presumably in the long run you wind up with some kind of market for people to bring assets to the table, like we're going to go out there and build the legal container for such and such an asset and this kind of an approach or something.
And this is what really is important, is that this is going to require an absolute army of different projects and organizations. And that's why we've created this alliance, the Sweetbridge Alliance, which is made up of law firms. It's made up of other, blockchain projects.
Yep.
It's made up of service firms, all with this goal of basically creating one unified, common economic structure that allows us to bring these assets into the blockchain so that they can start to be, because there's other things, there's side effects of this. I mean, once you can actually borrow from your house, it means you can also buy your house on the blockchain. It means that literally you can go through, a 5-minute escrow.
Sure.
It means
Sure.
it means all sorts of things that start to come out of this as side effects.
Absolutely.
And there are literally hundreds of organizations that can participate in this, because we're talking about $54 trillion of global trade. This is the big kahuna. This
And it's
is
all of the organizations which have assets inside of that system that are close to the blockchain.
Absolutely. So this is not a small thing. This is a really big thing.
This reminds me a little of the formation of Visa.
Yes.
Visa was a tight, narrow vertical in that it was just a set of banks that were required. But Sweetbridge Alliance is basically a modern Visa. We're going to bring together, a set of disparate actors who have a unified economic interest in figuring out how to make these things fungible, and then you bring those actors together, build the initial IT infrastructure, and then gradually expand the domain of acceptance. So basically, it's a 21st century Visa.
It is, except this time, we can actually help fund, grow, and create liquidity for those entities and integrate our economics through token design and protocols. That means that you can actually, if you're using one piece of the alliance, you can snap in these other pieces, and they immediately seamlessly work together.
Yes.
So it's more like we're creating an operating system for an economy.
Yes.
Well, and where the app builders are building applications that work within an economy. It's like, and this is what I don't think people have cottoned on to, is that the blockchain allows you to create entire economic systems, whole economic frameworks.
Absolutely.
And that means that you can create virtual economies that live on top of national economies.
I mean, this is the history thing, right?
Yeah.
So because the blockchain as a technology came with a specific economic model wrapped around it in the form of Bitcoin, people haven't really understood that there are plurality of different economic modes that you can build on the same underlying technology.
That's it.
So you've got a new economic model
Yeah.
that you can put on top of the technology. So here's the Bitcoin economic model, it's basically libertarian. Here's your economic model, it's basically resource-based. Different models, different economic models, you just plug them on top of the core technology.
And then when people buy into that, you get so you think of what Ethereum has done with the explosion of all the ICOs and the tokens and stuff, and what that has generated. Think of what happens when you start doing that for things like real world stuff that's real substantive global trade
and
in an integrated economic environment. That's when this whole thing takes off at levels that nobody's can even understand.
Right, because in this instance, the growth isn't in that you're printing money and then trying to find assets to back it.
No.
It's that you're finding assets that want access to blockchain-style transactability, and those then themselves become the foundation for your currencies.
Frictionless, liquid environments. This is going to be big.
So I take a set of assets that I have, like a real estate portfolio. I figure out how to get it recognized as property inside of the Sweetbridge system. I bring it into the Sweetbridge system in such a way that it now has access to the liquidity and all the other features. And that's how the Sweetbridge economy grows.
Yeah.
And I can pull the assets back out and put them back into the real world very simply. They never actually leave the real world.
They never leave the real world.
Right. So
why would you ever pull them out?
Well, because there's no difference between them being inside and outside, apart from the fact that once they're in, they get access.
I can now transact against them in ways that I couldn't before, and I can actually borrow from them.
It's almost like an extension module for the current system.
Yeah.
You have a house, it's got a set of APIs that allow you to buy it, sell it, lease it, lend it, whatever it is, and then you add this kind of Sweetbridge layer on top by putting the deed into the system in a recognized form, and now it's got all these kind of blockchain APIs on top of it. It's almost like painting a layer of a new economy directly on top of the old economy.
That's exactly right.
And
one which is the common globally.
Yeah.
So where the rules on a global basis aren't different.
Yeah.
But you have they're like device drivers were to computers, you have a device driver within each legal jurisdiction
Right.
that deals with that specific.
So you take your asset,
Yep.
you plug the Sweetbridge legal connector onto your asset,
it, yep.
and then it connects it to the Sweetbridge sort of backplane of services that plug it into a blockchain.
Now you're in
version
a
of the
common
blockchain.
operating system economically, and everything inside of that operating system can actually work in a new system.
And then all the tracking that people are interested in terms of things like fair trade and environmental certification, all this.
all just comes along with it.
Side of it, It
And the
is-
money to do all this, the massive investments,
comes from the liquidity.
comes from the
provision.
liquidity.
It's amazing. I mean,
Yeah.
it is. I mean, you know, I remember tweeting about a month ago that I was finally beginning to see blockchain projects that kind of lived up to the potential that the technology had obviously had, but we hadn't seen realized. And this is that. I mean, it is the biggest thing that I've ever seen by a fairly large order of magnitude. And I'm very happy to be part of it and proud to be helping promote it.
Well, and I love the fact that we've connected. I mean, it was like this instant,
we had been
mind meld.
groping in this direction, but only groping. Because, I mean, the thing is that the 20 years of experience you've got in supply chain, you really understand how 50, 60, 80% of the economy actually functions.
Yes.
The practicality of it. And that is the thing that I keep coming back to, that although there is a ton of theoretical complexity in Sweetbridge, the actual practicality of how you implement.
The go-to-market strategy is simple. Give
Yeah.
money away for free. It's going to be popular.
Kind of hard to beat that.
It's going to be popular.
So is there anything that we have missed that we ought to touch on before we wind up? You mentioned something about being able to track process efficiencies, like if some talented person moved to a new company and
That's
improved
just
things.
worth mentioning.
Yeah, I think
This
so.
is the ultimate state, I think, is that people become emancipated from needing to work for companies, because once you can tell the accounting effect of every little tiny piece of a supply chain,
Right.
and you have visibility to what's happening, you know what its current efficiency is.
Yep.
I can now, as an independent actor, come in and propose a change that, if accepted and implemented, we can actually measure the impact, the performance outcome of the work I did.
So I
And
come in, and it's like a performance bond.
so I can perform, and I can get now compensated based on the effect I had on a localized economy element.
So I come to your company and say, look, I can do your procurement more efficiently than your current procurement guy. You say, show me, I do, and then I automatically get paid a cut.
And it's enforced by the blockchain in a smart contract that basically makes it happen.
Yep.
So think of this for music. This totally redoes the music industry. Because all the creative industries have all these people that create stuff that, if they don't do a lot of work to try to protect the things they create, they lose access to it. Now they can actually say, let me put it out there. Let me just distribute it broadly. Allow it to be copied. But whenever it gets used, the system actually recognizes it's being used and uses a standardized terms of use to basically extract the value from it.
It's like compulsory licensing without the compulsory.
Without the compulsory. Well, you could do this for software. Now I can just put my software out there, and as it gets used,
anywhere somebody's using it, it's
get paid.
demonstrable on chain.
I can do this with all sorts of intellectual property, chemical processes, scientific research, all sorts of things.
Because you can prove when the thing is being used because you've got this open backplane.
That's it.
And the open backplane...
And can measure actual economic impact or economic use of it, and I can get a piece of that.
And what's paying for the costs of maintaining the open backplane is the interest-free lending.
That's it.
It really is a new economy. I mean, it's a completely different way of assembling the pieces that we have. But, I mean, the critical thing is that it doesn't require whole systems change initially. One vertical at a time, one asset class at a time, one nation
at a time, downloading our app on their phone or on their computer, and that's when they start.
Bloody hell.
Yep.
Yeah, marvelous. Well, this has been absolutely fantastic. I'm sure that there will be people that listen to this over like 5 or 6 sessions. Okay, my brain is full. I have to stop now, and it's been like that recording. Marvelous, sir. Glad to be here.
Thanks.
Okay, thanks, guys.